Hello, everybody. Good morning, good afternoon, and welcome to FX Street. My name is Jeremy Wagner of Daily FX Education, and I want to welcome you guys to this special monthly webinar. And first of all, I want to provide a thank you to Maud and Vicki for hosting me today. It's a pleasure to be able to spend some time with you guys, talk about trading. Who wouldn't want to spend a couple of hours among some friends and talk about the markets and what's going on and what types of trading opportunities may be on the horizon. And so we've got a lot of great things in store for today. This is the first in a two-part series. The title of this first section is Trading Patterns versus Trading Predictions. And so what we're going to be doing is going out, just a minute here. There we go. Some technical difficulties there. But what we're going to be doing is going out and talking about the difference of trading patterns versus trading predictions and what the main difference is between them. And I'll just go ahead and tip my hand to you. It is emotions. And we're going to get into some patterns that we could use to trade into the market. Now, there's only a handful of patterns that I'm going to have time to go over today, so I do want to make this for you guys. So if there are patterns that you like to trade, I see we've got a couple of them in the chat box already. Go ahead and type those patterns in, and then we'll have some time here towards the end to take a look at these patterns. And if you see any trading opportunities on any of the patterns that you see in the chat box or any of the patterns that I'm going to be talking about today as well, type in the currency pair, the time frame that you're looking at, and also the pattern, and we'll take a look at that live as well. So Harley zigzags 1, 2, 3, and I see John, I think he mentioned the 1, 2, 3 as well. That is going to be a big part of what I'm going over in the second part of this session. The second part, which is going to be coming up in about 90 minutes, is going to be how you behave when you see equal waves. And so the zigzag, the 1, 2, 3 pattern, or the ABC pattern is a very important part, key element to that. So I may go over it a little bit today, but I'll be this morning or in the first part, but I will definitely be talking a lot about the 1, 2, 3 in the second half on part 2. And the equal wave pattern, just go ahead and finish that up, is a pattern that probably many folks have not heard of or how to use it to help identify some trading opportunities or future projection of prices. And so both of these topics work well together. And so we're going to go ahead and get started. Harmonics, Mike, I see that. Yes, there is a certain type of harmonic pattern that I like to trade. And so we'll definitely go out and take a look at that. That one's a little more complex as far as the way that I trade it, but I have a specific rigid set of rules on how I do it, so I will get to that one later as well. We'll also talk about some fundamentals. So we've got a lot of things going on out in the market. Here's an outline of some of the things that I've got on tap for today. This morning, the U.S. dollar durable goods report came out, and so we're going to tie that into the predictive nature, which is going to be the first part of this presentation. Also, with the unrest going on in North Africa, and there's some thoughts and some talk about peak oil coming back into the nomenclature of hey, we may be running out of oil. We're getting skittish. The earthquakes in Japan could be diverting what was nuclear energy towards more traditional sources of energy like oil, and so you got these peak oil predictions starting to crop up again. And so we're going to tie that in to how that generates a trading opportunity. And then to connect the predictions versus patterns, I'm going to give you a fly-on-the-wall analogy. And after that, we are going to go take a look at patterns and go straight to the charts. Now, the objective, the thing that I want you guys to walk away from on this first section, this part 1 of 2 on trading patterns versus trading predictions, I want you to walk away with how when you're talking in terms of predictions, it entices you to become emotionally attached. And so it's like it doesn't matter what happens on the trade, you're going to do everything it takes in order to be correct. And what comes to mind when I speak something like that is a movie of Chevy Chase and Vegas Vacation, and where it was like no matter what, he was going to beat that dealer. And even if he, went through thousands of dollars to do so, he was going to be right at least once. And that is becoming emotionally attached to your trades. I think we've all done that at some time or another. And the less that we can do of that, then the more we can detach ourselves. And that's what pattern recognition does. It allows you to trade objectively because it removes your emotions. You look at the pattern for what it is, and then you risk a fairly small amount. If you're right, great. If you're wrong, hey, it happens. It happens to everybody. And sometimes you can even be wrong more than you're right and still give yourself an opportunity to go ahead and increase your account balance. So predicting versus reacting. So this morning, I guess it was about 90 minutes ago, about an hour and a half ago, USD durable goods order was expected to come in at 1.2% to the positive. And it actually came in to the negative, about negative 0.9%. So well, let's see how that affected the prices. You should be able to see my screen now. Let's look at a 15-minute chart. There we go. Should be able to see the chart now. This is the euro dollar. Let's move this down to a 15-minute chart. So about an hour and a half ago would have been about right here. And you can see that prices on the euro dollar is nowhere different. It's about the exact same place as where it was prior to this durable goods order coming out. So, here's a situation where you hear a lot of economists, you hear a lot of people talking about, oh, we think durable goods is going to become this, we think non-farm payrolls is going to become that, we think this, we predict that. And in the end, I don't know if you noticed this or not, but in the end, prices usually end up about where they were to begin with. And so when it comes to predicting what non-farm payroll is going to be next week, to me, there isn't a whole lot of value in doing so. It's more of a spectator type of sport where it's interesting to see the 15 to 20 minutes of gyrations and volatility that occurs once that release is made. But by and large, there's an expectation in the market, and it's already been priced in. And so the patterns and the trend lines that you see in the market generally hold up during these types of news releases. Peak oil. Let me get back here to the slide. Now, peak oil, like I said earlier, has been coming into play much more regularly with the earthquake in Japan and the nuclear reactors having the potential for meltdown and radiation leaking into the water sources and possibly increasing the health hazards on humans. Ingesting water, drinking the water, coming up with food to eat. It's scary. I mean, to be honest with you, and my heart goes out to the folks that are having to live through that over in Japan. And so what that's doing is because of the side effects of nuclear energy, now people are moving back towards or starting to think towards more traditional sources. Oil, which there's an abundance of out there, and we use it in almost everything. They're using that to play on our emotions, like, oh my gosh, we were relying on nuclear power to some degree, and now all of a sudden we're going more towards oil, and we use oil for everything. This computer that you're watching me on right now has oil involved in it. And I don't know how a computer is made, but even if there is not a drop of oil in the computer, the fact is that in order for that computer to get to your desk, it had to arrive on a truck at some point in time. Some point during its manufacturing, it was driven on a truck. Well, a truck needs oil in order to operate. And so everything that we touch is involved with oil at some point in time. Yeah, Mike, thank you very much. All the plastics come from oil. That's good. So, but even beside that, like I said, even transportation and trucking, a truck carries everything that we touch, and so oil is involved in everything we do. So we begin to think about these things, and it starts to play on our emotions. It's like, oh my gosh, oil's going to have to blow through the roof because of this. And what I just said is a prediction. Just because all of this is going on doesn't mean that oil will go through the roof. We've heard of reasons and arguments of why oil could go through the roof. It's because of the situation in Japan. It's because of the unrest in North Africa. But by the same token, somebody else is going to argue that, well, you know what, the higher the oil gets, then the more drag it's going to become on the local economy, and it's going to put the local economies back into a recession. And as it goes into a recession, people just aren't going to have the money to spend. Therefore, they're not going to have the money to spend to buy goods, and that demand for oil is going to back off. So you could see how there's an argument on both sides of the equation. And so my point of bringing this up to you is that peak oil is just a prediction. If we want to see what's really going on in the markets, we need to check out the charts. Because if there is a strong uptrend in oil, it's going to show up in charts. If oil is having a hard time reaching new highs, it's going to show up in the charts. And all this is derived from the patterns. And to help drive this point home, I do want to give you a fly-on-the-wall type of scenario. So let's say that you're in a dark room and you're a fly on the wall, and all of a sudden it's quiet, and then all of a sudden you hear this noise. And it's a rant, rant, rant type of noise. Sounds like an alarm. Perhaps it's a fire alarm, and then you see some movement. Somebody rolls over in bed, they slaps their alarm, they get up out of bed, hop in the shower, get dressed in nice clothes, eat breakfast, and then they leave. And you notice this occurring day after day after day. Well, being a pattern recognition connoisseur, you're like, okay, I think this person is going to work. They're waking up in the morning, and they're getting into the shower, they're getting dressed in nice clothes, they eat breakfast, they go off to work. Now, just because you witness that sequence of events does not mean that every time and every day that person's going to go off to work. Many times that's likely to be the case. But as you can imagine, there is a situation, or there are situations, where that person could wake up in the morning, hop in the shower, get dressed in nice clothes, eat breakfast, and leave, but they could go somewhere else. They could be off to the doctor's office, or they could be going on a business trip to go visit friends or family on the other side of town. So as the fly on the wall does it really matter whether they're going to work or not? The point is that you see a recurring pattern, and you want to make a trade or a judgment based off of that pattern, but in the end, it doesn't really matter whether they go to work or not, because sometimes you're going to be right, sometimes you're going to be wrong. You want to make sure that you're risking a small amount of your account so that if you are wrong, you can come back and you can trade that pattern again the next time. And Boyke, I agree with you. Leave predicting to the weather forecasters. If I was going to be a weather forecaster, I'd want to live like someplace like Las Vegas, where forecasting the weather would be pretty simple. It's going to be hot and sunny because it's a desert out there. So yeah, emotions, they're not logical, and since emotions are not logical, we want to step away from the emotions, and we want to move more towards patterns. Here's a couple of patterns I've got lined up for today. I see we've got a couple of others that folks have lined up in the chat box, and we'll get to those as well. I'm going to start off with simple support and resistance. We may not think of that as a pattern, but you've heard the old adage of connect 2 points, and that becomes a support or resistance level. Place a trade based on the third touch of that. And that can be a very effective pattern to trade, and it's probably one of the more popular ones out there. And so I've got a simple support and resistance trade lined up, which we're very close. Possibly could be entering here on the next couple of days, and I think you might be interested in seeing it. It's on the pound dollar. Head and shoulders patterns. I am very picky on how I look at head and shoulders patterns. Some people are going to have more of a loose interpretation of it. That's fine, but in the end, I'm trying to find an edge to these types of patterns, and so I want them to be very strict interpretations, or at least I'm looking for very strict interpretations, so that there is a less amount of potential wiggle room of that pattern failing. And then flags is a pattern that you're probably familiar with if you saw it, but you may not be familiar with the name of it. And I got some interesting examples lined up for it and triangles. And the interesting about triangles is this is affected by the Japanese yen, a very large triangle that had been forming prior to the earthquake. So even before something major like the earthquake happened, the pattern of the triangle was forming on the Japanese yen, which you could have biased yourself to the downside, and perhaps, if you were, had entry orders available, perhaps could have gotten triggered into that. All right, let's go to the charts. Just a moment here while I change my screen. So what I'm going to do is I'm going to go over a few of these patterns, and I see you guys have some other patterns in the chat box. I see the harmonics. We'll take a look at a way that I trade those harmonics, and we'll see if we can find any setups available in the harmonics here lately. Actually, one does come to mind on the stock indices, so remind me to take a look at the stock indices with regards to harmonics. And Paul Volcker, I'm looking at your comment right now. It says that the current pattern on the yen is striking. Is this the CB's, central banks, keeping it in a tight range, or are the traders afraid? Let me go ahead and grab this question real quick, and then we'll talk more about the Japanese yen once we get to the triangles. Now, what's interesting about the Japanese yen is this big long up candle that you see right here. This was central bank intervention, the Bank of Japan, coming out, intervening. They were buying dollars and selling Japanese yen. The Japanese yen was getting simply too strong, too fast, and it was going to cripple their economy is what they were fearing, and so they intervened. And then look what we have now. We've got basically straight sideways action that has been trading in about a 30 to 40 pip range for the last couple of days. Very, very tight pattern. Okay, so this should be a dollar-yen 1 hour chart is what you should be able to see right now. And I've got a slow stochastics at the bottom, got a very strong up move here. And right here's where you'll see the currency pair that I'm looking at, the dollar-yen. Okay, I'm getting some okays and goods. So you notice how this thing has been trading straight sideways for 30, 40 pips? Well, I saw this last night, and you know, there has not been a budge one way or the other. So are traders afraid? Possibly. This reminds me of when the Swiss National Bank was intervening on the Euro-Swiss pair. So I am changing my chart right now. This is a Euro-Swiss. Can you guys see the Euro-Swiss weekly chart? Let me scroll back in time. Actually, right here. Paul Volcker says no on the Euro-Swiss weekly chart. All right, let me turn this off, turn it back on. Okay, so this should be the Euro-Swiss weekly chart. And I'll try to remember to do that, to go ahead and turn the chart on, turn it off, and turn it back on. But right here, you can see that it traded in a very tight range. That's where the Swiss National Bank was coming out and intervening. And then finally, they're like, my goodness, we spent billions of dollars intervening, and they just were not able to budge the price. It was just trading in a very horizontal range. So they gave up at the beginning of 2010, and you can see what happened to price since then. So what this tells me with regards to the dollar-yen, just a minute here, let me change my chart again. What this tells me about the dollar-yen is that possibly the Bank of Japan may be out there intervening and creating this sideways action where there's just no net movement one way or the other. It's also possible that traders are so skittish and afraid to trade this. They don't want to trade against the central bank. But one thing I do want to say, that's a very important concept when it comes to central bank intervention. Sometimes it works. A lot of times it doesn't. Let's think about this for a minute. If the central bank is intervening, if the Bank of Japan is coming out here and saying, hey, the yen has gotten too strong, we're going to intervene into the market, they are essentially placing a counter-trend trade because they're trying to push the market in a direction where the market doesn't want to go. The market wants to go down on the dollar-yen. The central bank is trying to come in and push it back up. And so the central bank, by its very nature, when they intervene in the market, they are counter-trend traders. And so what that means is that sometimes they're going to be right, but a lot of times they're going to be wrong. And let me move out to a daily chart. Does this? Can you guys now see the daily chart on the euro, the dollar-yen currency pair? This is the daily chart on the dollar-yen. And this blue candle, large blue candle that we see in September, okay, let me change this. This large blue candle that you see in September was Bank of Japan intervention. They intervened, and then immediately after they got done intervening, prices came back down and broke down to a new low. And so that's a recent example of how intervention did not work. And so, you know, how long is the central bank going to intervene on this? I don't know. I don't have the crystal ball. I don't have the red phone directly to Japan on that matter. But another recent example of how it doesn't work. How soon do interventions hit the news? A lot of times what you'll find is that it's a rumor. You know, when you get a very large move, there's a rumor of intervention, and maybe they leak it out. But yeah, that would be great, Mr. Volker, and lending out the red phone. Maybe we could share it with everybody here in the room. But the point is, you don't know until after it's done. Very good question, Boyke. Why do patterns repeat? And I really like your question, because the short answer to it is because we're humans. Why do we do the things that we do? We're humans. We're glutton for punishment. We keep doing the same thing over and over and over and over. So, for example, sometimes, you know, if I get in a foul mood, you know, I'll tend to want to eat my way out of a foul mood. All right. So why do I do it? It's not good for me to do it that way, but I do it. It's just the way that I'm programmed, the way that I'm built. And so when you look at a market like the dollar yen or any of the financial markets, it is mass emotion. It's mass psychology. It's greed versus fear, and there is no rational reason why things happen. There's no logic behind it. It's just emotions, and we cannot predict emotions, but those emotions do repeat. We cycle up and down between greed and fear. We get greedy, and then all of a sudden, when we're greedy, even though that housing is at all-time highs and is gaining 5 or 10% a year, which back in 2005, 2006 has never been sustained in the past, we know that, but we rationalize every reason in the world why housing is the best investment. And so we go out and we buy houses at already elevated prices. And that's because we're in a greedy mode. And then all of a sudden, prices start to drop, we get a little scared, we get a little skittish, and then we start to turn into a fear type of mode. And then when we get into a fear type of mode, even though things are at bargain basement prices, we feel that it's much better just to hang on to our cash than to go out and buy a house, or to go out and take on a mortgage, go out and buy a new car. We feel like it's much better for us to hang on to that cash because we've just been sent through the ringer. And so it's that cycle of greed versus fear, and they do repeat as we cycle up and down through it. All right, let me get to a trading opportunity. I'm going to switch over here to the pound dollar. This is going to be a weekly chart, so you can follow along with me at your with your chart at home. And here you go. This should be the pound dollar weekly chart, simple support and resistance. I noticed this a couple of days ago, and let me go ahead and add a trend line on here. Basically what I'm going to do is I'm going to connect these 2 points right here and extend the line out. Guess where this line puts me? Puts me right on top of prices right now. Prices are right on top of this resistance line. Basically what this tells me is that for the last 3.5 years, prices have been contained below this resistance line. And so it takes 2 points to create a line. The third touch of that line tends to be a good entry into that trade. And so we've got one, I believe, here on the pound dollar. Now the pound has been on a bit of an uptrend on a daily type of chart or a smaller time frame. So this is a much longer time frame. So prices have been contained below here on a weekly basis. This means on a relative basis, the pound is a lot weaker than the U.S. dollar. And that may strike you as a little funny, because if we think about it, what's in the news about the U.S. dollar? The U.S. dollar has been getting weak. The central bank has been out there, the Fed has been out there printing money and buying up treasuries and trying to create more liquidity. So we've heard all about this dollar weakness, which again starts to play on your emotions a little bit. But if we take a look at the patterns out in the market, well, this says the dollar's actually been a lot stronger than the pound, at least over the last 3.5 years. So the dollar may not be as weak as maybe we think it is. And so I think this does present an interesting longer-term possibility until prices are successful in breaking above this black line. We got to think that the longer-term trend is to the downside here on the pound dollar. And on my stochastics, I've got it on the 14, 3, and 3 setting. That's the slow stochastics at the bottom of the chart. You can see that I'm in overbought territory on a weekly basis, starting to turn down. I've got a bearish candle formation here, a little bit of a wick to the upside. So perhaps we're in that zone where prices may be reverting to the downside. Now, this is something you're going to want to give yourself a couple hundred pips of stop loss on this. You're going to have a stop maybe in the mid to upper 6,000s. So perhaps see if we can get a bounce higher and tighten up that stop on this a little bit. But this is something that I've got my antenna up. I got my radar up on and thinking, okay, we're at an interesting juncture here where prices may start to sell off on this pound dollar, which means that the pound may be getting weaker relative to the dollar. And so personally, I would be looking for a tighter stop on this, seeing if we can get back up about that 6,400, which was the high, I think, over the last day. What percentage of patterns repeat is what Boyke's asking, and the patterns will repeat. It's just a question of what time frame of chart that you're looking at. And maybe the question is, or maybe restate your question is, well, what percentage of the patterns are successful? And, you know, for that's going to depend on your interpretation of the pattern. And I'm going to talk about that when I get into the head and shoulders here. So let's go ahead and change screens over into head and shoulders. Just a moment. Let me turn this off. And for the first head and shoulders, I'm going to share with you a head and shoulders pattern that did not work. It was one that I actually got faked out on. So just a moment. Okay, this is a daily chart on the New Zealand US dollar. And so what I'm looking for when I'm taking a look at a head and shoulders pattern is I'm looking for symmetry. And what I'm looking for symmetry is the spacing between the shoulders and the neckline. So let me go ahead and label this chart so that you guys at home can see what it is that I'm looking at. So this may be your left shoulder. So I'm going to type in an LS for left shoulder. This would be your head, and this would be your right shoulder. Okay, so symmetry-wise, I want the shoulders, I'm looking for the shoulders to be at about the same height. And you can see here, the height of the left shoulder was about 76.30. The height of the right shoulder was around 76.63. So it was within 30 pips, which when you're talking about 600 pips, that's fairly close. It's not going to be to the exact pip, but as you can see, it's fairly symmetrical. And then the distance on the left half of the pattern is symmetrical to the distance on the right half of the pattern. And so it looks to be a fairly clean head and shoulders pattern. And then lastly, I'm looking at the neckline, which when you connect, in this case, the lows between the left and the right shoulders, when you connect those lows, you can see that my neckline slopes downward very slightly, but it is fairly horizontal. And so that's the last thing I'm looking for, is I'm looking for a horizontal neckline, or possibly even sloping to the downside. So in taking a look at this pattern, this fit my parameters, my very strict parameters. And so how you would trade this is you would trade this on a break below the black line. And you can see we got that in December. And you could place your stop just above the swing high here. And whoops, we got stopped out. So this was a situation where the pattern actually did not work out, and it fit my strict guidelines. So one of the things that I want you guys to take away from is that it's not only identifying the pattern, but it's making sure that the amount that you're risking is a small percentage of your account, 1-2%. That way, if you are wrong, you'll have enough capital to be able to come back and trade the pattern the next time it happens. Now, there's a very interesting, talking about equities here, there's a very interesting pattern showing up on the Dow 30. This is a very, very long-term pattern. So this is going to be the Dow Industrials. Turn it back on. This is the Dow Industrials. This is actually the CFD that mimics the Dow Industrials. We call it the US 30. And so if you have a live account, if you have residents outside the United States, you have the ability to trade this with FXCM. And take a look at this. You guys see the head and shoulders pattern here? Let me go ahead and label it for you. So this would be our left shoulder here. This would be our head. And this would be the right shoulder. And so when we look at the symmetry between the left shoulder and the right shoulder, the left shoulder was coming in around 11,760, and the right shoulder made it up to about 12,400. And so it's not perfect, but it is fairly symmetrical. The symmetry from left side to right side isn't quite as symmetrical as we would like to see. The right side is very much compressed. But the other thing that makes this interesting is take a look at this neckline. The neckline is sloping to the downside. And so again, when you're looking at a head and shoulders pattern, the reason I like it to be horizontal or downward sloping is because what this is saying is that prices are so weak that this support at around 7,200, this support was not strong enough to hold it, that it crashed down below it. It eventually did find support just below it and move back up above, but when you get a downward sloping neckline like this, it means that prices were so weak that it could not be supported at the previous neckline support. And so this would indicate, just by looking at this pattern as it is, that potential weakness lies ahead. If you're a more aggressive trader, you may anticipate this right shoulder and place a stop just above the high here. And that way, instead of waiting for the neckline break, you're also trying to capture in this move here to the downside as well. But again, taking a look at this pattern, this would indicate that some weakness lies ahead. All right, let's move on here to actually Harley's asking what does it pay per pip on the Dow 30. I believe it's one lot is going to be $1 per pip. Let me check the station here real quick. So yeah, if you trade that at one lot, it will be $1 per pip. Okay. Let's move on here. That was the bullish head and shoulders. Let me briefly go over an inverted head and shoulders. Okay, so head and shoulders, like what I just shared with you, is actually a bearish type of pattern. And what that means is that prices are expected to sell off when you see a head and shoulders. Now this one is incomplete, and it is a little sloppy, and we're in the process of forming it right now. But because of the sell-off that we've seen on this pound-Aussie pair, I'm watching this 57 to 5,800 level. Because if we come down, if it finds support at this level and starts to move up, you should be looking at the pound-Aussie daily chart right now. If it finds support in this 57 to 5,800 and moves up to break through 65, this could be our inverted head and shoulders. And so here's how it would shape out. Here's our left shoulder. Here's our head, and then right now we may be forming the right shoulder. So this is a bit speculative. It's definitely premature to call this the way that it is based on a couple of other patterns that I'm going to share with you. I'm not convinced that this is going to shake out, but I'm definitely watching it just in case that it does. And so you can see the left shoulder, so my neckline would be connecting this to here. In this case, I have a very slightly upward sloping neckline, which means that this resistance was weak and that it was not able to hold and contain the prices as they pushed upward. And so, again, if we support at 57, 5,800 and come back and break through 65, that could possibly be an interesting place to enter into a long trade on the pound Aussie. But we're several hundred pips away from that happening. But here's a pattern that may be occurring in real time. All right, flags. Let's move on to flags. I see that Chuck's got a question in there. Can you explain about the V-shape, W-shape, bear, bullish pennant, bear flag? I'm not sure. All right, I'm going to go over the flags here, and we'll take a look at these. So let me turn the chart off, turn it back on. So the first one we're going to look at, we're going to take a look at some bull flags. And for this, I'm going to take a look at the Aussie Canadian dollar. Aussie dollar, Canadian dollar. This is going to be on a daily chart. So here we go, the Aussie Canadian dollar, and here's where the flag gets its name. All right, so this is how the flag gets its name. This would be the flagpole, this strong up move, and then prices. After you get a strong move like this, prices need to digest and consolidate these areas. So as it consolidates, it just drifts up and down and back and forth with a very, very slight downward slope here. And so this is how the flag gets its name. This is the flagpole. This channel, this trend channel, is the flag. And so what would happen is, if indeed this is correct, prices may break out to the upside and zoom on higher. And a lot of times the distance of the flagpole can be the distance of the breakout as well. So they can be very powerful types of formations. And so when you look at this right now, you think, man, long the Aussie CAD, that seems a little strange. That means the Australian dollar is going to have to be fairly strong. That means that the Canadian dollar is going to have to be fairly weak. In light of oil prices and the direction that they're going, the Canadian dollar tends to have a correlation to the price of oil, and it's like, my goodness, the Canadian dollar getting relatively weak just doesn't seem right based on this formation. And so, but again, that's using emotions. You know, we're getting emotionally attached to oil and thinking oil has to go up, but oil doesn't have to go up. We're just taking in some of these worldwide events that are going on and thinking that it has to go up, and therefore we're thinking the Canadian dollar has to get stronger. But this pattern is suggesting that on a relative basis, the Australian dollar may be stronger than the Canadian dollar into the future. Now, the way I would look to trade this is I would look to get another bounce here off of the bottom line here and try to get an entry going long towards the bottom of this price. The thing about buying a breakout above this upward line is that you have a couple of areas of resistance just above it. So it may be difficult and it may take a time to break through that resistance, where if we can buy at the bottom of this channel, then that could give us a little bit of breathing room for once we get up, if we get up into that territory. So this would be a flagpole, and then you're flagged off to the right-hand side. Basically a pennant. Chuck, you mentioned a bear and a bullish pennant. A pennant is going to be a similar type of situation. You get a strong up move, and then you're going to get a triangle. And so instead of a consolidation in a trend channel, you're going to get a consolidation through a triangle. And let's see here. I see, Emma, I see your question. Am I trading the Euro Swiss? I did about a month ago. I haven't traded it lately. The Swiss has me foiled a little bit. The Euro, I do think that the Euro, based on a couple of these charts, that the Euro's got some weakness lying ahead. And Mike, I see your comment there. Euro dollar, pound dollar breaking out above resistance. Watch trades. So yeah, I'm looking at it more from a longer term perspective. If you're looking on a shorter term perspective, maybe an intraday type of trade, it's possible you could get some upward movement in those currency pairs. Let me go ahead and share with you an assessment on the Euro. And I'm going to talk more about the Euro in the second half here on the how to behave when you see equal waves. And the Euro dollar fits that mold. But I can tell you that where I'm looking at to be some significant resistance that I'm looking to sell short into is the 43.50 to 44.50 area. So we are getting very close to that. And when you consider that the pound dollar is very close to its weekly resistance line as well, maybe these currency pairs have a little bit more upward push to them. And if they do, great. Gives me a better opportunity to get into a short trade at a higher price. But I think there are going to be some good, in my opinion. I think those zones that I shared with you on the pound dollar and this zone that I'm going to be talking about in the second portion here, how to behave when you see equal waves, 43.50 to 44.50 on the Euro dollar, I think those are going to be fairly significant trading zones for looking for a short trade. So in light of that, okay, pound dollar maybe over the longer term moving back to the downside, and Euro dollar back to the downside. Let's take a look at the Euro yen, because the Euro yen has a bearish flag formation to it. So the chart you should be seeing now is the Euro yen daily chart, And so again, what I'm doing is simply creating this trend channel. I'm connecting the low here and the low here, and then I duplicate the line and move it to the top. You'll notice we've been conforming on the euro-yen, so we got a strong move to the downside. We're consolidating this strong move. Now, as prices are in this flag are drifting ever so slightly to the upside. Notice this is not a strong trend. I don't have a very steep trend channel. It's a very slight upward sloping trend channel. And so this is a consolidation of this previous move to the downside, in my opinion. So let's zoom in here. What does this mean for trading opportunities on the euro-yen? Well, the top side of this line is at 117.50. So if this euro-yen price pushes up into the 117s, I'm going to start getting excited about this. I'm going to start thinking that we might have a trading opportunity to the downside. Now, the pound dollar might be a couple hundred pips away from maybe some upward potential before some significant resistance is overhead. The euro dollar might have a couple hundred pips above it until it gets into that 43.50, 44.50 zone, which I'll provide more technicals on that on the second portion of this. Now take a look here at the euro-yen. Euro-yen is a couple hundred pips away from a potential resistance zone. So do you see how some of these patterns are starting to mesh together, and meaning that sentiment on these pairs is starting to get to the point where people are looking long the sterling or looking long the euro, and very bearish on the U.S. dollar, very bearish on the Japanese yen. But I'm looking at these pairs in earnest and thinking that we may see a resumption of these original trends, perhaps coming up in the next couple of weeks. Carl says, Carl Blank, on the euro yen, you also have an inverted head and shoulders, so it would break to the upside rather than the downside. Okay, let's see here where we might have an inverted head and shoulders. Where would give me the rough time frame of where you would put the left shoulder and where you would put the head and the right shoulder, so we can take a look at this in real time. So Carl, if you could go ahead and type in where you think that left shoulder is, where you think the head is, and then where you would see the right shoulder as being, and then we'll take a look at that. Harley says, do you ever fib? Do I ever do a fib in between these channels? The only thing that I utilize inside the channels is a center line. So I guess it would be the equivalent of maybe a 50% line. A lot of times prices will respect that center line. But other than that, I don't use Fibonacci within a channel. I don't know if there's any validity to it because I don't know how many people really use it. All right, Carl. So once you get that typed in, Carl, we'll come back and we'll take a look on that inverted head and shoulders. I don't see it, but if you type in that left shoulder head and the right shoulder, we'll come back and take a look at that. In the meantime, I do want to move on to another equity pair here. And again, this is taking a very, very long-term look. This is the NAS 100. This mimics the NASDAQ 100. And so again, this is another CFD that is available to trade. This is a monthly chart. So we're going back 20 years here. And notice, we had the bubble, the very strong move to the upside. It has corrected that strong move to the upside. What goes up must come down. Have you guys ever noticed? I don't know if you've done much study on bubbles, but I don't think there's been a bubble that has ever been sustained over the long run. So whenever you get a significant move like this, it doesn't last forever, and eventually it goes back to that point of origination. And you know what? I'm going to come back to the NASDAQ for a moment. Let's check out the Nikkei, the Japanese stock market. Okay, let me turn the camera on here. Okay, you guys remember the Japanese bubble back in the late 80s? And I think when was it? Yeah, it was like the last day of 1989 was the top. And so it's sold off. It's been correcting that. And you'll notice that it corrected all the way back down to where the origination of the bubble began. And so that's what tends to happen when you have a bubble, is that it gets fully corrected. And so if we change charts back to the NASDAQ, I don't mean to rain on anybody's parade here, but if we change charts back to the NASDAQ, what that would suggest is that eventually we're going to get back to these levels where this bubble originally started at. And so we got a down move, and as far as a bear flag goes, notice how if I draw a line connecting these two lows, and if I duplicate this line, look what happens. On a monthly basis, we're right at the top of this line. So if you wanted to be a more aggressive trader and perhaps wanting to short in a fairly strong uptrend, according to this pattern, this would suggest that there is some weakness lying ahead. Now, this isn't anything that's going to happen overnight. If it does, if it happens, it's not going to happen in a week or a month. You know, this is a monthly chart, so this is many years of data, but this does give you an indication that perhaps there may be some weakness in the markets ahead. So if oil, for example, if oil does continue to make its strong move to the upside, that could become a drag on the markets. Yeah, Mike, you're absolutely right. That was the dot-com bubble there in the late 90s. And I don't know if you guys know, have heard of this or not, but the euro-yen sometimes can act as a proxy towards the stock markets, U.S. stock markets. The pound-dollar. Okay, check this out. If you're familiar with running correlations in Excel, you can come out here. You can download prices. I didn't think about this till just now, otherwise I would have done it. But if you download prices from the charts into an Excel spreadsheet, you can run correlations on them, and you'll find that the correlation between the pound-dollar, or there is a correlation over the longer term between the pound-dollar and U.S. stock markets and the euro-yen and U.S. stock markets. So notice how all of them are showing that there is some limited upside. So if you're in these trades to the long side, you'll want to be careful. If you're an aggressive trader, you possibly might want to consider dipping your toe into some short trades. If you're a more conservative trader and you don't want to go long and you're a little too scared to go short, that's okay. What you do is then you scale down to a smaller time frame chart. So here, I'm looking at the NASDAQ monthly chart. So what you do is maybe we scale down to a daily chart. And you look for trend lines to get broken. Once those support trend lines are broken, then that could be your clue to go ahead and enter in short. That would allow you some more confirmation in the trade before entering, and what you're giving up on balance is that price. So you're going to be entering in at a lower price, but you're saying, hey, I'm okay to enter in a lower price so long as these support lines get broken. Okay, so Carl mentioned here on the euro-yen, let's go back, take a look at this. See, if you look on the one-day, one-year frame, the overall pattern looks like a left shoulder, and then the head with the sloppy right shoulder, and the neck comes in at 115.40. Perhaps, maybe if, I could see maybe how somebody might consider this to be the left shoulder. Maybe the head, and maybe the right shoulder, but again, yeah, it's not real clean. When it comes to head and shoulder patterns, I like to be very picky in them because there are some loose interpretations of what they might be. Let me give you an example. This is on a tangent here a little bit, but let's go back to that euro dollar, and let me see if I can recreate this. I haven't looked at this in a long time, but I had seen this interpretation of a head and shoulders pattern on the euro dollar. So this is a monthly chart on the euro dollar, and what they did, it was somewhat interesting. What they did is they drew this line here, and basically what they were saying is this was your left shoulder, this is your head, and that this is your right shoulder. Now, perhaps that could be the case, and then this black line right here is the neckline, and we had a false break below this neckline. Perhaps that's true, but you could see how it's a little sloppy, it gets a little cumbersome, gets a little more difficult to see how to trade it. So somebody could interpret it this way, and that's perfectly okay. That's fine. But when it comes to me and when I'm looking for head and shoulders pattern, I want to be very disciplined, very strict about the rules that apply to it, so that I'm not morphing it into something that it really wasn't meant to be, and therefore opening up my account to additional losses. Mike says, or asks, can we overlay two securities on the same chart? You absolutely can, and so let's go ahead and do that real quick. On Let's do it on the euro yen. These correlations have been out of whack a little bit. And let me add, oops, let me turn my camera back on. Let me add an overlay of the Dow, the Dow Industrials. Okay, it may take it a minute to load here. And so you can see, yeah, it began to diverge here in late 2009. Notice how the euro yen dropped, and then the stock market kept moving on up higher. But if we move back in time, you'll see how they've generally been running together, and then it diverged there in 2009. Okay, let me get into some triangles here. Now, again, if you guys see any other patterns showing up here, let me check through the chat box real quick. If you guys see any other patterns showing up, type those in, and we'll take a look at it. Harmonics. I do want to try to get to harmonics. Let's see, there was something else in here as well. Just a moment. Oh, and the ABC 123. Yeah, that one will be coming up on the second part of this. Rob says, do I count waves? I do incorporate Elliott wave into the patterns that I look at, and I look for Elliott wave to match up with the patterns. So the first one I want to share with you is the dollar yen. And let me get rid of this. Turn on the camera. Okay, here's the dollar yen daily chart. And you'll notice, right, here's our triangle pattern. I'm looking for 5 legs of the triangle pattern. That fits into the Elliott wave definition of the A, B, C, D, E. So let me draw this for you. And even if you don't know Elliott wave, or if you don't know how to count to 5, or ABC, that's okay. You can still use the 5 legs of a triangle pattern to help distinguish a potential entry. So notice I've got a downtrend, and a lot of times when you get a triangle consolidation, it will occur after a very strong move. So a very strong move to the downside. Prices are consolidating that strong move. It's contracting inside a triangle, and then many times prices will break out in the direction of the preceding trend. So the preceding trend was to the downside. Sure enough, we got a break to the downside by virtue of the earthquake over in Japan. Now let's take a closer look at this. 5 legs of the triangle. So I start it. Once this downtrend stops, we start up here. So this would be A, B, C, D, and then E. Okay? Now, whether you put B there or you put B there, it doesn't really matter. There are 5 legs on this triangle, and so we would look for a break below this black line. Sure enough, the break occurred on some pretty volatile prices, and then what was support tends to act like new resistance. So a possible entry, if you're looking for a short trade, could be going short near this black line. Prices came back, retested it, and then it did find resistance. So it's possible we may still see some lower prices ahead here for the dollar yen. And when you factor that in with the central bank and the Bank of Japan coming out and intervening, it just doesn't make sense. It's like, my goodness, man, they're intervening. Why would you want to go short? And it's like, remember, central bank intervention means that they are trading against the trend. And so it doesn't always work. You do need to be cautious because they could intervene and they could shoot this thing up a couple hundred pips in a moment's flash. But if they don't intervene, then lower prices may lie ahead on this. Let me show you another triangle as another example of a pattern. Do you guys use triangles much? I tend to find myself finding triangles, I think because of the Elliott wave nature of how it fits into Elliott wave, and triangles help me position myself within the Elliott wave sequence. So I find myself looking for triangles quite often. And so I'm just kind of curious from you guys. Do you guys use triangles quite a bit? Never heard of them before? Didn't know about them? What are y'all's thoughts on triangles? Yeah, Harley says not really. Well, here's one on the dollar CAD. This one occurred here a few months back, and again, there's 5 waves to it: A, B, C, D, E, and this is how it would shape out. So this would be our A. This would be B, C, D, and then E. As it gets towards the end of this triangle, notice how on both of these examples, how it never did make it to those support or resistance lines. And that just tells you how that struggle, that push and the pull between the bears and the bulls couldn't even push it towards the support or resistance level. But once you get to point E, that is a good entry point, or you can place a breakout below the low end of the triangle, and eventually the dollar CAD did break out here to the downside. So most everybody does ABCs. Yeah, that's a very good pattern, and like I said, I've got a lot of information coming up on ABCs here in the second part of the hour. If you guys see any ABC patterns in the market right now, type those in, and we'll give that a quick look. Before we get to that one, Mike says a recent bullish Gartley on the euro-dollar 1 hour chart. So while you guys are typing in an ABC pattern to take a look at, let me take a look here at this euro-dollar 1 hour bullish Gartley. Between March the 11th and March the 17th. Oh, you know what? That's a 1 minute time frame. No wonder it wasn't working. There we go. March the 11th through March the 17th. And this is the euro-dollar 1 hour chart. Yeah, in this case, I really don't see the one that sticks out to me. And let me show you how I trade it, or what I look for. An M-shaped one. Okay, yeah. I can see the M right there. And ideally, what I would like to see on that, I call it the squished M. I like to see the right side of the M to be squished down, like somebody was holding a balloon or holding a ball below water. You like to see it pushed down and squished a little bit, and then I like to see this right arm right here also penetrate lower than the middle. So basically, if you take that leg and if you just shift it down a little bit, then yeah, that would be one that would get me excited about trading it. But let me show you one, and taking a look at the equities. This is one that I think it was back in January. I think it was the SPX 500, which mimics the S&P 500. Had a bearish Gartley on it that I was taking a look at. So let me turn the camera back on, and let's change this. I tell you what, let me change this over to a weekly chart. Okay, do you guys see the bearish harmonic on this one? And what I do, there's three types of fib levels that I'm looking for. The first one is I'm looking for an overall retracement of 61% or 78.6%. And so let me go ahead and get my fib set up here for 61.8, 7.86. And let's darken this line up, thicken it up. Okay, so there's this whole down move from the top in 2007 to the low in 2009. Here's my 61% retracement level. Here's my 78% retracement level. That's the first thing I do. Second thing I'll do is I'll come out and I'll measure the distance from this low right here to the high point right there. Oops, I got to turn that off, the extension. All right, so I'm basically measuring the distance from the low point up to this high point, just a raw distance. And that's what the length of this line represents. And then I project that out over here, and I'll throw a 1.0 or a 6.1 retracement level on that projection. So I know it seems a little confusing at first, but so this is a bit beyond. This is part of the reason why I didn't have it planned for today, because it is a little confusing if this is the first time you've seen it, so just bear with me. So I take this distance and I throw a 1.0 or a 618 retracement on it as well. And then the last thing that I'll do is an external Fibonacci from this high to this low. And for that, I'm looking at the 127 and the 161. Let's make that one orange. Okay, so it must have been around the turn of the year. Yeah, prices were around 1250 here on the SPX 500. And what I noticed when I was seeing this Gartley starting to form, because Gartley is rooted in Elliott wave. The harmonic patterns are rooted in Elliott wave if you think about it. 5 waves to the downside, this is essentially just a big 3-wave counter trend move. And if it's true, it should stop here at some point before the high. But notice how I've got a confluence of all these retracement levels coming in the same area, and it's around 1351 to 1380. And sure enough, look what happened to prices. It came up, just missed it by a few points. So we could possibly see it come up and give it another test. But if you factor a lot of these things together, we've got a fairly significant resistance zone right here on the S&P 500. We've got the NASDAQ area that I was sharing with you. We've got the euro yen. We've got the pound dollar. We've got the euro dollar, all showing that we're close. And so if you're long those pairs, you might want to be looking for an exit plan over the next few pips or points. If you're wanting to be an aggressive trader, these would be aggressive places to enter into these to the short side. If you want to be a conservative trader, then one way to be conservative is, again, draw some sort of support line. Since these are all uptrends, recent uptrends, draw some sort of support line. Look for prices to break down below the support. That would be your signal confirmation to go ahead and get into it. But yeah, this could be an ABC. You got A, B, C, and so this is a little bit of what I was going to be getting into. But when it comes to harmonics, that was one that came to my mind off the top of my head, where you've got a lot of these lines coming together. That's what I look for. Again, I try to be picky on these types of patterns. I'm looking for these lines to come together at that same point. Why is that important? Okay, let me give you an example of why that's important. Let's say that I gave you a hammer. I said, hey, I want you to go ahead and I want you to beat a hole in the wall with the hammer. All right, so you take the hammer, you start swinging away. Doesn't take you too long. You got a hole in the wall. Now, I want you to take that hammer and I want you to go to a corner where 2 walls come together, and I want you to beat a hole in the wall there. And so all right, so you go to the corner, you start beating on it. It's a little bit harder. Eventually, you probably are able to break a hole through the wall, but notice how it was much more difficult when you have 2 levels of support or resistance coming together. Notice how it was much more difficult to break that hole in. And so the more areas of support and resistance that are confluing in the same zone, the stronger that support or resistance is, and therefore it's a lot harder for prices to push through that level. So when I see something like this and I see these zones very tight together, that indicates to me that it's a very strong resistance level. It could eventually break, but it does also offer a potential strong entry point. Okay, English says go over the fib on the 618 on the vertical line. What's the logic? Okay, the logic here is that it's rooted in Elliott wave. That when you have an ABC pattern, let me label this for you. So this would be A, B, C. An ABC pattern that is corrective. A lot of times the length of this leg is going to be 1.00 or 0.618 of the A leg. Or the third one is it could be a 1.618 as well. And again, this is the logic that's rooted behind the next webinar that I'm going to be going over here in about 45 minutes. The equal wave theory, because this is where you get the equal. And so, but the 618 also applies, and also the 1618. Rob says, do I trade only off of these bigger time frame charts? No, I do not. What you'll find is that I'm about 90% technical and 10% fundamental. And so I will use the longer term time frame charts to help guide me from a fundamental bias. And so, for example, if we take a look here on these longer time frame charts of like the euro and the pound, and it looks like we're approaching a level that could be fairly significant. Well, the dollar could get stronger. Why is it that the dollar could get stronger? Everybody's screaming weakness. Well, it boils back to what I was sharing with you on the pound dollar on the pound dollar weekly chart. I got to draw this line again. Prices have been contained below this resistance line for 3.5 years. So for 3.5 years, on a relative basis, the dollar's been stronger than the pound. But yet that's not what we hear out in the news. We talk about how weak the dollar is. Well, if the dollar was super weak, well, this pound-dollar rate should be way up here by 2, where it was back in 2007, 2008, and it's not. People hear about a weak dollar because of the Canadian dollar, the Australian dollar, and they're relating it to that or the yen. But relative to some of these other currencies, the dollar's actually been stronger on a relative basis. So if we're looking to go long the dollar, to me, it's something like a pound dollar or a euro dollar is where you're going to want to shoot the gun and point the gun at. Going long the dollar versus the Aussie is going to be a challenging counter-trend move. Going long the dollar against the Canadian dollar could be a tough counter-trend move. But against the pound, I mean, let's face it, the pound hasn't really made any real progress ever since 2008, early 2009. But as far as time frames of charts, inside Daily FX Education, we do webinars as well, and on those webinars, I will spend a lot of time on 1-hour charts, occasionally move down to a 15-minute chart, but most of the time spent on the 1 hour, a little bit of the 4 hour, a little bit of the daily, a little bit of the 15-minute. So just sharing these longer-term patterns with you here to give you that bigger picture. If you guys are interested in wanting to join us inside Daily FX Education, I'd be happy to hear from you. Simply, all you need to do is just send me an email, and that's at instructor@dailyfx.com. Just say, hey, I want more information about the patterns and how to trade off of them. Also, I'd like a temporary access to our mentorship program. I can provide you a 2-week temporary access just for simply being a part of FX Street and joining me here on this webinar. You guys have an exclusive invitation to that for the next couple of weeks. Send me an email, instructor@dailyfx.com, and I'll get that off to you guys. So, Wah says, would I short at the trend line? On the pound dollar, yes, I am considering a short trade here. This isn't anything that you're going to want to rush into, meaning you could go to bed tonight, you could wake up tomorrow morning, and the price may be 100 pips off of where it is. It could be 100 pips higher, it could be 100 pips lower. But at the end of the day, this type of trade is going to require several hundred pips of stop. And so I'm going to look for prices to play out a little bit longer and see how it behaves around this. And so maybe in the next week, I might take a trade on it, but I'm not rushing into it today or tomorrow. Perhaps next week. I'm going to see how the other markets are behaving, what's going on with interest rates, what's going on with the stock markets. I'm going to take some clues from those other markets as well to help guide me into this. But once it is in, again, you're going to need to give yourself probably 200 or 300 pips at a minimum of stop distance on this, and then you're going to want to manually trail the stop down. Since we were talking about smaller time frame charts, I did have one I was going to show you. This was a triangle here. I think it was on the pound Swiss 15-minute chart to show you that these can apply on shorter time frames as well. Yep. So this box right here is a triangle. And so again, the way that you trade it is once you get a strong move, prices tend to consolidate. And so here is where that consolidation would take place. That would be our A, B, C, D, and then E for Edward. So I got a 5-wave move. A lot of times it will move in the direction of the preceding trend, which in this case it was up. We triangle, consolidate, and then boom, we get our thrust outside of the triangle. A target distance, when you're looking at triangles, I didn't get to this earlier on the dollar-yen, but a triangle distance is usually the width of the mouth. So the distance between A and B, which is the height of this line, is typically the distance you're going to get on the breakout. So if we look at the breakout as being about right here, you can see it was pretty close to approaching that price. And same thing here on the dollar yen as well. Okay, so what I'm going to do is I'm going to take the distance between the of the triangle, so right, and then I take this line. This line is not a trend line. It's just a line that shows me distance and length. And I project it from the point of the breakout, and you can see prices did overshoot it a little bit, but notice how it overshot, came right back, snapped right back. Sorry about that. Here is the chart. And so I just drew this line at the mouth of the triangle, projected it at the point of breakout. And so the dollar yen did push just below it and then snapped right back. So this did meet the triangle projection. All right, we just got a few more minutes left here, and then we're going to take a 30-minute break. So if you guys have any additional patterns that you want to take a look at, go ahead and type those into the chat box. But the next one that's going to be coming up is going to be spinning off a particular pattern, which I alluded to you here, which is the equal length pattern. And it is rooted in Elliott wave. You don't have to know Elliott wave in order to trade it. But it was a little bit about what I showed you on that harmonics earlier on the SPX 500. That plays into that camp. But the euro dollar has been littered with a lot of these equal waves. And so it has provided me, I have gotten faked out of a couple of trades on the euro dollar, but it has also provided me some comfort in giving me an idea of where prices are likely to trade to in the near future, which is where I've derived this 43.50 to 44.50 area for a sell short zone on the euro dollar. And so, yeah, the next English, you're right, the next class is going to start in about 40 minutes, and it will last for an hour and a half, and that is going to be for the premium folks. So if you guys have any additional questions, I'll be happy to take them here for the next few minutes. Thank you, Mr. Volker. I had a great time with dinner with you and your wife the other day. Just kidding. I don't know Paul Volker. I don't have access to the red phone, but hopefully one of these days you can offer me that line and provide me access to the red phone. And again, I'm going to go ahead and leave my email address down here. So again, if you guys are interested in wanting to receive a temporary access to our mentorship program, give me an email. It's for 2 weeks. There's no charge for you. And then also, if you're interested in a Word document of trading some of these patterns, you can print it off, keep it near your desk. You can try it out on any time frame of chart. Just keep in mind that the shorter time frames you get into, you may get more signals, but those signals tend to be less reliable. The longer time frames tend to be more reliable type of signals. You just get less of them. So feel free to send me an email, and we'll get you hooked up with that as well as temporary access if that's what you're interested in. And you guys have been great. A lot of great questions. A lot of good charts to take a look at that you guys have contributed, and additional patterns with the ABCs and the harmonics. And we'll talk to you guys soon. Mike, do FXCM Live clients have access to it? Yes. If you're a live client and if you're not familiar with it, Mike, go ahead and send me that email, and we'll get you the details of it. But yes, by having a live account, you do have that available to you. And thank you guys. Thank you guys for your comments and your interaction. And you guys were a great crowd. And I look forward to working with you guys here in the premium section coming up in about 40 minutes.